Hello everyone. On today's edition of The Final Bar, we're going to look at the broad market pullback of sorts with a nice healthy rally into the close. We're also going to look in particular at the commodity complex in a segment called Commodity Corner. We're going to break down the broad commodity space, but also oil, gold, the metals, all the different components and what signal we're seeing. In a segment called Level Up, we're going to look at relative strength and why it's important to look at stocks relative to their peers, the broad market benchmark. Ladies and gentlemen, this is The Final Bar. Hey everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks so much for joining us every weekday here to look at the movements of the day, connect it to the long-term trends, hopefully make some proper decisions, proper understanding about the long-term trends and the momentum in the markets. Quite the day, right, with the down move out of the open, and then as the markets have sort of digested the news from China, impeachment, all these things, market sort of slowly but surely rallies to close more in a position of strength than at the open. So there are a lot of geopolitical, a lot of big picture themes happening. And so today we're going to dig into some of those themes and how they're reflected on the charts, and including a good look at the commodity space. So thanks so much for joining us today. Before we get to the charts, I did want to remind you about some of the special events we have coming up. We have Mark Ungewitter next week on January 27th from Capital Trust. On January 28th, we have Dana Lyons, founder and editor of the Lion Share. So two fantastic strategists sharing some of their takes on the world the next week. On January 29th, mark this down, we have 50 Years on Wall Street. This is unveiling our documentary interview with Ralph Acampora. Had a fantastic visit with him. We just previewed the video here in the office earlier today. You're not going to want to miss that on January 29th. And then just so you know, on February 3rd, Final Bar will actually be on the road. We're heading out to Atlanta and to Orlando, and we're going to finish up at the Money Show down in Orlando. And so we have some really cool content we're going to bring to you during that week on the road. We're also going to be capturing some fantastic interviews, which we'll look forward to sharing with you on the show soon. A lot of good things coming up. Keep watching every weekday, 4 o'clock Eastern. Let's, folks, get to the market recap. So we've had quite a day today, and it's funny, I always joke that my prep time for the show, I think it immediately causes volatility. Volatility is injected into the markets the moment I open my laptop, get my lunch, and start thinking about how I want to approach the show. Today was no different. Today was a bit of a follow-through. So we sort of, if you just look at today's bar, we traded lower, the S&P getting down to just touching above 3,300, and then just sort of this nice accumulation, sort of chipping away, finishing off toward the highs of the day, back into the middle of the range from yesterday. So while at the open, the first half of the day in the morning, it felt a little weaker rather than stronger, really shows the accumulation coming in. And again, I think it's, there's a lot of news flow, a lot of earnings, but also the news out of China with the viral outbreak and how that's all being sort of handled and processed. The news from the WHO sort of has affected things and certainly has given people more confidence that this is potentially not going to be a big shock to equity. So overall, sort of maintains this uptrend that we've seen. I was interviewed on a podcast earlier today, and we were talking about, again, the path of least resistance remains positive. The trend is positive. We've made higher highs, higher lows. Until that pattern changes, the trend is up. So keep treating it that way, again, until we see evidence otherwise. Let's look at the member dashboard page. So this is my favorite way to break down what we're seeing, asset allocation, but down to the sectors, the stocks, the industries that are driving your portfolio returns. So the S&P 500 finishing just above flat for the day. You can see the big gap down in the morning, but that sort of slow and steady accumulation after lunch that finished above the close from yesterday toward the highs of the day. So up 0.1%, so not much, sort of flat for the day. Small and mid caps up a little bit more, so both up about 0.2%, so a little bit more, but overall sort of a flat digestion kind of day. But again, I think the story is more the accumulation, which shows you the short-term demand, the calming of the nerves, I guess, maybe that the last couple of days have brought forth. Looking at the sector returns, we had industrials, real estate, utilities, 1, 2, 3. So again, one of these, the juxtaposition we're seeing right now is defensive, yield-oriented, income-oriented sectors like real estate and utilities at the top of the list. Even on a day that finished in the green, you have some of the more defensive part of the markets that were leading the way positive, so up almost 1% both ways. Industrials up number one. A lot of that's the transports, things like airlines that did really well when it feels like travel negativity might have abated a little bit. We'll talk about that in a little bit. Technology also up, outperforming the market notably. And the bottom of the list, we have healthcare, we have communication services, energy. And again, I feel like most days I could sort of just expect energy at the bottom. It does not disappoint, continues to be one of the underperformers. So no real change in what we've seen there. In terms of what we've seen globally, so on the positive side, a couple ETFs up pretty good. Brazil up the most. As oil prices sort of recover a little bit, something like Brazil is going to do pretty well. At the bottom, we have all the China-related ETFs, essentially. So most of the China ETFs we've talked about, also Taiwan, Korea, and again, just thinking of the impacts of potential travel implications of the news coming out of China. Looking at the Dow industry groups, you can see railroads and airlines at the top of the list, up 3% and then 2.2% for the two of those. And again, those are all airlines certainly related to the news out of China. You can see the XAL refreshing the chart here, finishing toward the highs of the day. This is something that had pulled back the last couple days, and then just today, obviously, a lot of recovery as people expecting less of an impact on their business with all of the potential travel restrictions. Again, that is still a pretty live, fluid story, so I don't know if we can declare that one in the clear by any means, but certainly that's what we saw today. Also, home construction. We talked about home builders yesterday, and again, this group, the home constructors, home improvement retail, all continuing to do really, really well. And again, a string of nice up days becomes a nice upward trend. If you look at the candle chart that I'm showing you here on the preview, look at that consistent, that's 2 weeks plus, every day, those nice open candles, just showing you accumulation into the close of every trading day. So doing pretty well there. Just to note on the downside, the ones that are down, coal has been a pretty rough group within energy. You also have some materials groups, but then you're getting into some, maybe more of a head scratcher. Clothing and accessories, that is more earnings related. The broadcasting entertainment, this comes out of the news with Netflix and others expecting some lighter streaming volume than they might have expected. So all the broadcasters, media companies down pretty good today, even Disney, which a little more diversified. All those groups are down the most. You can see here on the scooter laggards today, you have Fox, Discovery Communications, Comcast, all down on the bottom end. On the upside, you have some of the railroads like UNP, CSX, also PayPal, Netflix, Align Technologies, number of names on the top there. So some interesting themes to pick out there. Again, if you're not familiar with some of these ways to break down movements during the day, go to your member dashboard and add all of these objects on it. It's a great way to just understand what's happening. And again, we get very caught up in the news flow, earnings, China, impeachment, whatever. This is telling you price. This is telling you what's actually happening. So well worth reviewing. Our next segment today is called Commodity Corner. This might have been the first time we've done this. I can't remember actually, but the idea that we talked about was to really focus on some of the different asset classes in more detail. So with commodities, it's a perfect time to bring this up because you've had this huge change, of course, where commodities had been very strong leading into the end of the year, and then almost on a dime, we celebrate the new year, and then all of a sudden commodities start to weaken. So I want to talk about that change in character from strength to weakness. Oil prices in a little more detail, thinking about one of the biggest weights in most commodity indexes is oil. So talk about the weakness in oil and what that means. And then we'll finish off with some of the bright spots in the commodity space, in particular gold, which has been really one of the better long-term charts, I think, anywhere in any asset class. So let's look at each of those one at a time. So there are a number of ways to look at the broad commodity complex. I'm showing you 3 of them here. We have the CRB index. We have the GSCI Commodity Index, and GSG is the ETF that tracks that one. Then we have DBC, which is the DB Commodity Index. And all of them are very similar. The weightings are different, which is why they're not identical. So they weight the different parts of the commodity space in different balances. Most of them, if not all 3 of those, have a pretty significant exposure to energy. So if oil, natural gas, those things are weaker or stronger, that's really going to drive the movements here. Let's bring up the GSG. Again, I think any of these are fairly interchangeable in terms of the trend. It's all just a little bit different on the weightings, but let's look at what they're telling you. So with the commodities index, you sort of had the fourth quarter of last year, a sell-off at the end of September, but then look at October, November, December, just a nice rally. And I remember doing the show here the last couple weeks of the year and thinking, wow, we have commodities breaking to new swing highs, breaking above a significant resistance level. So, the GSG getting above 1620 and appearing to have staying power was actually really encouraging. You can see it was becoming overbought with the RSI, but that was fine, assuming that there was the beginning of something further up. But then look at how all of that changed in the first week of January. All of this reversed lower, and this beautiful breakout became more of a failed breakout. All these commodity indexes started to come down. Now you have the GSG testing the oversold level. This puts it more similar to what we saw in August and in June of last year, where it was more of a bearish phase. You saw it become oversold. That was a bounce within a longer-term downtrend. So it almost feels like we've changed from a bullish characteristics that we saw here in the fourth quarter with the RSI remaining above 40. Now we're more in the bearish range with the RSI getting more depressed, looking more similar to what we saw in mid-2019. So this might be telling us about further weakness in commodities. And again, until you see a recovery, until you see a return back above some of these resistance levels, back above 1620, I would say for the GSG, and if it's able to find support below some of these previous levels, it might tell you that maybe the negativity is alleviated, but until then, certainly weaker rather than stronger. Now, a big weighting on the negativity there is the oil prices. So we have a couple different ways to look at oil. $ WTIC is the West Texas Intermediate crude contract. So it's taking it from the futures market. That's updates at the end of every day. And so you'll see the historical value. So if you're trying to get a good historical perspective on oil, I think this is one of the best places to do it. Oil prices have come down significantly, and this big turn in oil has been one of the biggest impacts. Now, obviously, we've had news from Iran and the Middle East, which has impacted oil for sure. Now, potentially, we've had the news from China is impacting it as well. So we'll see if the negativity there, if the comments from the World Health Organization today sort of provide more of confidence or less negativity about travel and confidence in getting around. Maybe this price will sort of recover a little bit, but overall it was sort of lightening up based on weakening demand or expectations of that. Right now, oil is at a very interesting point because the RSI is just below 40. It's lining up with where it was back in August and October when we had previous bottoms in the price of oil. So it'd be interesting to see if we see a similar pattern. You can see the support here around 54, 50, 55. So if it comes down even more, that's really the level at which oil, I think, has bottomed out before. If you're looking for more of a short-term read on oil, you can always look at the USO, which is a real-time, it's an ETF that's trading just like anything else. So you had accumulation going into the close today on the USO, I think based on sort of overall expectations. And the USO is actually right at the oversold level. So right at support, right oversold, sort of suggesting a little bit of an upside bounce here. So that's that characteristic of oil, sort of the negative move year to date is what's caused all of these commodity indexes to look weaker rather than stronger. I did want to pivot a little bit though and talk about where in the commodity space things actually don't look so bad. So one thing I would note, again, one of my mentors and good friends, Walter Deemer, was a longtime technical analyst at Putnam in the 70s and 80s, really knowledgeable guy, pointed out to me recently, what about the GCC, which is the Wisdom Tree commodity ETF, but it's weighted a little differently. So it's more of an equal weighted read on commodities. So it doesn't have that huge exposure in oil. It's more of a broader exposure to hard and soft commodities, energy, everything else. And as you can see here, it is certainly sold off year to date. That's totally fair. But if you look here at the last 6 months, it actually looks pretty constructive, right? Fairly solid. So even though this is a pullback, we're right at the 50-day moving average. We've been putting in higher highs and higher lows. The trend has been positive. The RSI is not anywhere near the oversold region. It's more in the bullish pullback kind of camp. So if you're trying to get a better read about the broader commodity complex outside of oil and energy, this is maybe a better way to do it. And overall, it's not nearly as bad. Tells you it's been a pullback within a longer-term uptrend. And I think one of the reasons for that is looking at gold and some of the precious metals. Let's look actually first at copper. So $ copper is the copper future. You can see with copper, this is a common one people like to look at, call it Dr. Copper, because it tends to be a good read on economic stability, economic growth, because if you're going to grow things, you're going to add things, you're going to add physical plants and so forth. You need industrial metals, you need base metals, things like copper. And so what you can see is it's traded up to resistance. It's the level at which it's hit resistance before over the last couple of years has certainly pulled back. And right now, I think it's at a really important point. You want to look at where copper is relative to the lows from the beginning of the year, that first week in January when we had that first pullback. And one of two things is going to happen. Either we bounce here off the 50-day off support, rally back to these previous highs and see if we can eclipse them, or we fail here. We go below the low from the beginning of January, go below the 50-day, RSI breaks below 40, it tells you more weakness, and that would be maybe more of a negative sign overall for the broad equity markets. But now let's finish with what actually looks fairly attractive. So the GLD or the gold index, either one of them look very, very similar because the GLD actually holds physical gold. So it's a good read on the actual spot price of gold. What I'm seeing here is a similarity from the fourth quarter, maybe the second half of 2019, and the middle or the first half of 2018. So this is the beginning of 2019, forgive me. So here we had this nice rally in February, this sell-off March, April, May, and then this resolution to the upside, breaking above trendline resistance, breaking above the most recent swing high, breaking to new highs, gapping up. Now we see a very similar pattern here, September through December, pulling back to the same Fibonacci support level that we saw back here in March, and then rallying back above trendline resistance, testing new highs, and arguably sort of giving this little shallow bottom and starting to retest new highs. So as long as the GLD remains above 145, I would argue it's actually a pretty decent chart. And if you look at the last 2 years of gold in terms of this transition from distribution to accumulation, pretty positive, actually, pretty good. So overall, again, with commodities, there's been quite a reversal in the first couple weeks of the year. There are some interesting spots to look at, and I think gold in particular is one to pay attention to. That's our commodity corner for a Thursday afternoon. We now want to introduce or give you a little preview of our interview with Ralph Acampora. So as you may or may not know, we had a chance to travel to Minnesota, spend time with Ralph Acampora at his barn outside of Minneapolis. It was a fantastic day spent learning about his career history, market history, the value of technical analysis, and the value of data visualization, really the stories you can tell by visualizing market history. So here's a quick preview of our upcoming documentary called 50 Years on Wall Street, featuring Ralph Acampora. Here we go.
I was staring at the north wall of my barn.
Okay.
It's plain, it's boring, it's this whitish color. Mm-hmm. It's 70 feet long, it's about 18 feet high, and just blank. And I said to myself, 2017, I'm going to be 50 years in the business. Wouldn't it be cool if I could just put the history of the stock market? That's where the idea came from. I wanted to capture my 50 years.
So that was just a sneak peek on a documentary we created based on our conversations with Ralph Acampora. And again, talk about 50 plus years on Wall Street using technical analysis with great success. Ralph, as you may or may not know, was one of the founders of the CMT Association back in the early 1970s. So we just previewed a version of that earlier today here in the StockCharts office. You're in store for a really, really cool experience, learning from one of the masters of technical analysis, Ralph Acampora. So that's actually previewing on StockCharts TV next week on January 29th. So make sure you check it out there, won't you? Now we want to go to our next segment called Level Up. So when we talk about this show, we talk about what we want to do, we certainly want to help you upgrade your use of technical analysis, upgrade your use of the StockCharts platform. So what we wanted to do is talk a little bit about relative strength today. And I don't mean RSI, I mean relative strength in terms of a stock or a security relative to other securities. So this is a chart of Pepsi back in 2007 and 2008. We're going to talk through this as an example to highlight what I found are the 3 ways we can use relative strength as an equity investor. Just to remind you, so this is RSI. This is not where we're going. RSI, I think, was a somewhat poorly named or a misnomer of sorts, calling it relative strength index, because I think what Wells Wilder was maybe getting at was RSI, relative strength index, is a price movement relative to its normal price movement, but it's really relative to itself. It's not comparing it to anything else. So RSI, some people actually call it internal strength because it's looking at the average move versus what's happening right now. Where are we at relative to where we normally are is how I tend to summarize it. The bottom panel here on the chart is actually looking at Pepsi divided by the spiders, right? So it's Pepsi relative to the S&P 500. This is the type of relative strength, what you might call true relative strength or relative performance, which is really looking at a ratio of one security versus another. There are a lot of ways we can look at relative strength relative to the industry, relative to a peer group. A lot of ratios are great ways of visualizing relative strength of two securities relative to one another. For today's purposes, we're going to talk mainly about what I consider the primary use of relative strength, which is looking at a stock relative to its benchmark. So for me, I'm always going to do it, or most of the time going to do it relative to the SPY. I have seen people, I would say the best thing you can do is when you're thinking about it, I tend to use the SPY because I'm thinking about the equity allocation in your portfolio. And when you're thinking about equities, do you want to be in an individual stock as opposed to being in the broad benchmark, just being in a passive fund like the spiders or the diamonds or something? So by looking at this ratio, you can make a good comparative analysis of how this stock is doing relative to that benchmark. So if you have a different benchmark, so if you were managing a fund relative to the Russell 2000 or something like that, that's what I would be putting on the bottom half, the denominator of that thing. But for 90% of people, if not more, I would say the spiders, the SPY, it's the right way to do it on our platform for sure. So there are three ways that you can use relative strength. Number one is as a technical indicator. Number two, as a market barometer. And number three, as a report card. And let me talk through each one of those individually, and I'll show you some examples about what I mean. When we're talking about a technical indicator, right, the relative strength tells us what the price is doing relative to all the other stocks we could be looking at. So here in the first half of 2007, so this is going from 2007 to 2009, so we're back 10 plus years, just to give a good historical example. The first half of 2007, you can see that Pepsi overall was in a period of accumulation, higher highs, higher lows, but look at the relative strength was essentially flat. So what does that tell you? As an indicator, what that tells you is Pepsi is moving in line with the market, even though the trend is up. The trend on the overall market is up, so it's not anything crazy, new or exciting. You're not really gaining a lot by owning Pepsi. You're not getting hurt, but you're not really adding value or generating alpha, as you would say, as an institution, earning something above the normal benchmark returns. But look at how different that is in the second half of 2007, when the price continues. So the trend really doesn't change, but look at how the relative strength changes. Because what happens is the market topped out here in the third to fourth quarters of 2007. The S&P 500 was actually rolling over already, but stocks like Pepsi, these more traditional blue chip names, continued higher. So the relative strength is actually pretty strong. So by looking at the relative strength line, you're using it sort of as a technical indicator, understanding whether or not this stock is actually doing better than some of my other options out there. Am I in the right names? So maybe another example, thinking more recently, would be the XLF, right? Thinking about the financial sector. Overall, is the price doing okay? Absolutely, right? It's been higher highs, higher lows. We've sort of stabilized. We're not making new highs at the moment, but we're not making new lows. We're sort of consolidating, sort of a sideways trend. That's fine for the last 6 weeks. But look at the relative strength over the last 2 to 3 months, right? Even though the price has been up to flat, holding up just fine, you're not losing money on it, but you're certainly underperforming the rest of the market because spaces like tech, industrials, utilities, all doing well, continuing to go to new highs, and that means the relative strength is turning lower. So as an indicator, you can use this relative strength line to qualify what you're seeing on the price. The price is fine, but the relative strength is negative, which means I may want to be looking for greener pastures somewhere else. Home builders might be a good comparison to that as well, right? You have home builders that are breaking out. The relative strength is actually a little muted, but once this relative strength, if this trend continues and if relative strength turns up, then that might be a trigger that I might want to revisit having more exposure to home builders and home builder names in my portfolio. So that's number one, using it as a technical indicator, owning stocks where the relative strength is improving. My friend Tom Boley, fellow host on StockCharts TV, has always said, if you want to outperform the S&P 500, you need to own stocks that are outperforming the S&P 500. The second thing you can do is use relative strength as a barometer. Let's go back to that example of Pepsi. We can see what this means here, right? As the stock is going higher and the relative strength improves so much, great, thumbs up that I'm owning Pepsi, but hold on a second. Why is a stock like Pepsi doing so well? This might actually be a chance to revisit why this stock is actually outperforming so much and what other stocks are doing. Think about the meaning of a fact that a conservative staple name like Pepsi is actually such a good outperformer. It doesn't tend to happen in a nice, incredible bull market. You can see as the market evolved in 2008, market corrected, we can see the relative strength changes. You can see how it performed very well, and then we have the sell-off, and you can see that things capitulate. The relative strength all fluctuates across the boards as stocks sell off into the lows and start to digest those losses, start to stabilize and see what happens. But the relative strength is a really good measure of overall market health. What sectors are doing well, what sectors are doing poorly? So one of the great ways we can actually do this is use the RRG, the relative rotation graph, which is taking relative strength, but then doing a new visualization to show how these sectors are rotating around the benchmark. We don't have time to get into this as part of today's show, but I'd encourage you to look at Julius de Kempener's work, his show, Sector Spotlight. Look at the videos on YouTube. You get some great real-time examples about how to use the RRG methodology. Then finally, you can use the third one as a report card, right? So the looking at the relative strength on something like the SHB, this is your report card. Are you in the right stocks or not? So thumbs up for owning something that's going up, but thumbs down for the fact that you own something that is not outperforming. In general, you want to be in places like this where the price is going up and the relative performance is increasing, because that means you're doing better than just a passive product. If you own things that are going up and the relative strength line is going down, you're not losing money, you're gaining money, but you're not gaining as much as you could being in some of the leadership names. So by using things like the scooter rankings, you can get a sense of which stocks may be in a better performance position relative to the names you're in. So that is relative strength. Those are the three ways you can use it: as an indicator, as a market barometer, and third, as a report card. We, however, need to wrap up the show, folks, with our 3 in 3. The idea is 3 charts in 3 minutes. If they're not on your radar yet, I hope they are from this moment on. The first chart of the 3 in 3 today is the percentage of stocks advancing versus declining. So the way that we look at this is it's a percent of stocks on the New York Stock Exchange up on the day and the percent down on the day here at the bottom in red. We can see for the last 2 days, it's been dead even. So even though the market recovered, market finished a little bit up on the day, it was pretty much a 50-50 split on the New York Stock Exchange with stocks advancing versus declining. Just were they above zero or below zero for their returns today? It's interesting to note how we've seen a bit of a downslope in the advancers. So in a healthy market, you'll get a lot of advancers, see a lot of stocks moving higher. That's what you want to see as the market's going to new highs. We're starting to see a lessening, right? So you don't have 60, 70, 80% of stocks making new highs. It's more 50%. It's sort of a crapshoot. It's 50-50. I think it speaks a little bit to the stock picking nature of where we're at. And again, out of anything, I would say the macro picture is very challenging. There are plenty of good charts out there. If you're a stock picker, I would be thinking about industry themes and stock groups. Use your screens effectively right about here. The second chart is gold. We talked about gold earlier. This is a chart of the GLD for the last couple of years. You can see this example that I was talking about, comparing early 2019 to late 2019, how I think we're in a similar page to where we were here in June before we had another nice rally to the upside. So a break above 149 on the GLD would really validate that thesis, suggest further upside. If we break down, go below 145, that would sort of suggest a little more caution. But overall, I think gold is setting up really, really nicely for gains through the coming months here. And then finally is China. You know, in a situation where you have a lot of news flow that's causing fluctuations, and this is the news out of the Wuhan province and the coronavirus. You know, seeing the China ETFs all coming off very quickly, it's worth noting that I think the FXI has actually come down to a pretty good support level around 42.50. This was resistance back in November. It also is lining up really well with the 50-day moving average. The RSI is just above 40. So traditionally in a bull market phase, this is about where you'd see this sort of thing bottom out. So I think we're at the moment of truth. Either we hold these levels, we're able to rally, or we break down below 42, 41.50, and that would suggest further weakness. And ladies and gentlemen, that is our show for today on a rainy Thursday afternoon here in Redmond, Washington. Thanks for joining us every day. We're going to be doing a mailbag segment tomorrow, so please send any questions, feedback that you have to our email, thefinalbar@stockcharts.com. We'd love to address them on the show live tomorrow. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.